Mihir Vora joins us. Let's take our conversation forward and understand that how much more to go before the bulls say it's time to take a breather. Mihir, the market surge has been nothing short of extraordinary. Given what has been thrown at the market in terms of sheer news event, election outcome, tax changes in budget, and markets have just shrugged it off. Why is that? Okay, I think I cannot hear you. You'll have to unmute yourself.
Good
मीर
morning,
ये
Nikunj.
सबके साथ हो रहा है.
I think
Everybody's lost their voice after the market run up.
nobody dislikes a up move. Don't worry, we all happy when the markets are up. So I think what we are seeing is a correction of a correction, in the sense that the big move in the last couple of weeks in the global markets, especially, in my view, was caused by the significant movement in the yen, where the yen was looking like it's out of control, and and typically what that means is that some of the carry trades start getting unwound. So we did see a lot of that happening. But now I think things are stabilizing a bit. The yen is also stabilized from the extreme weakness that it saw. So to that extent, we are seeing a bit of a return of the risk on trade in the global markets. We have the Fed meeting this week. People are expecting some dovishness out there. So I think a kind of a environment of a little bit of risk on is being set up globally, and we are, I think, benefiting from that. We also see some volatility. We also saw some volatility around the budget, which also is getting corrected. So I think we did see some sideways correction and some consolidation in the market, and I think we are forming a good base for the next quarter results, I would say.
Okay, so that's a view coming in. Hi, Mihir. This is Anisha also joining in the conversation. But, ultimately, markets are a follower of earnings, right? And this quarter, at least, earnings have been a bit more disappointing. Is it not fair to assume that we are, we have seen the peak of earnings upcycle and perhaps there could be an earnings risk down the corner?
Certainly, that's why I'm saying that we are in a consolidation phase, and I'd be happier if the market stays here for a while rather than goes up sharply. Because as you correctly mentioned, earnings have been a mixed bag, both for the in both the big sectors, I would say, which is financials as well as IT, which are dominant in the market, especially the large cap indices. So to that extent, I think it's more of a wait and watch. We have to see deposit growth coming back in the financial system, which is the banking and finance index, and we need to see some more sustained traction in order inflows for the IT companies, and some more margin improvement in the IT companies. So these are some of the data points I think the markets will be looking for the next few weeks, and I'll be happier if the market kind of takes a breather.
So in light of that opinion, Mihir, would you now be rejuggling your portfolio within private banks? While ICICI Bank sure was impressive, I don't know if the same qualifies for the rest of the pack. I mean, be it an Axis, IndusInd Bank, or even a smaller play like Bandhan.
Based on the results, I would not do much of rejigging. We were positioned accordingly. So I would say that within the financials, as of now, our positioning is broadly neutral to a little underweight on the private sector banks, neutral in the PSU banks, and we are overweight on the other financials, which is especially the capital market link plays, the distribution plays, the wealth management plays. So that's within the financials. That's where we are discerning.
Mihir, I have the first declared portfolio of your fund, and must say that you've decided to make it a very diversified portfolio. What is the stock count there? I mean, looks like it's about 35, 40 stocks.
We have 60 stocks in the portfolio. The benchmark, of course, is a very wide benchmark, which is the NSE 500. So from the 500 benchmark, we are focusing on about 55 to 60 stocks typically at any point in time.
60 stocks to start with, isn't that too much of diversification?
No, because you're just focusing on 10% of the benchmark, So if you look at our active share in the portfolio, it's close to 40-45%, which is reasonably high. Again, within the portfolio, if you see, the sector divergences are also quite sharp. For example, we are significantly overweight on the on the capital goods, the industrials, and the investment recovery theme, quite significantly overweight. We are significantly underweight on sectors like energy, utilities, and we are, of course, a little bit neutral to underweight on financials. Within financials, as I explained, we have quite sharp bets. So, while the number of stocks is what it is, which I think is reasonably focused, considering that we are only 10% of the benchmark in terms of number of stocks, within that also we are quite active on the stock and sector bets.
Now I'm looking at the top 5 sectors, and banks, of course, form the highest share of around 17% holdings, but autos is just around 6%. What's the view on autos? Because yes, they have run up, but a lot of tailwinds which are working out well for the sector and the companies. Would you be looking at increasing your weights within autos, or keep the same weight, just churn the companies within that? What's the strategy?
So in autos, we are neutral kind of on the OEMs, a little overweight on the auto ancillaries, because we think there is still a lot of scope for market share gains by auto ancillaries in exports. So that's the play we are playing. And we believe that the exports market share theme in the auto ancillary space is a far more sustainable trend. The OEMs, of course, will be more cyclical. So, and good thing is that you get monthly data. So to that extent, we are neutral because the sector has done very well. So some of the stocks that we bought, say even 1.5, 2 months, 3 months ago in the first portfolio, have done extremely well. So we are doing a bit of a profit booking in some of the sharp movements and trying to add to the ones where we feel the secular theme is more sustainable.
That there is a very large component to aerospace and defense, and since this is something which is looking at your fact sheet, I'm calling it out. 6% in aerospace and defense. Why? And are these stocks too expensive for anyone's comfort level?
Absolutely. So, Nikunj, you would remember when we launched the NFO, there were 3 themes that we talked about. One is the financialization savings, and within that, the wealth and the savings linked financials. So that's what we were bullish on. Consumption, especially premium consumption, is what we were bullish on. The second big theme was physical asset creation, which includes the whole gambit of infrastructure, real estate, capital goods, and of course the things that we talked about, which is aerospace, defense, etc., where there is intense focus by the government in terms of policy action as well as encouraging local production. So these are the themes that we believe that are doing very well secularly, and we will continue to be overweight on these. I would say that we had 3 or 4 stocks in the theme. Some of them actually went up too fast. So we have booked some profits there because they went up probably much beyond what we expected. And as I said, we've just been around for 3 months. And if you see stocks go up by 40-50% in 3 months, which is what we were expecting in terms of returns over 1 or 2 years. But if you are getting those returns in 2 months, we don't mind taking some profits, and we have done that.
Mihir, just wanted to understand whether or not, the takeaway from the budget, the adjustment in the cap gains tax, has that sort of brought about any nervousness around investors at all?
Well, it should have, but I think the global tailwinds are helping it out, and markets are just looking beyond that. I'm also pleasantly surprised, frankly speaking, the way the markets have moved.
So, Mir, are markets going up because there is flows on the sideline? Because that's the explanation which perhaps seems to be coming more and more, that okay, why markets are not falling? Because there are flows.
Of course, if you look at, for example, yesterday, both FIIs and DIIs are buyer to the extent of almost 2,000 to 3,000 crores each. So while DIIs have been net buyers in any case, the FIIs are more tactical in nature, and we saw that last week they turned buyers after being sellers probably for the previous couple of weeks. So I think the FII incrementally is influencing the markets tactically, but the DII flows are giving the base I would say support to the market in terms of sustained flows.
Okay, point taken. Has your view changed on pharma? Because the last time we had a conversation, you were a bit neutral on that space. Is it looking incrementally better, or any other space which you have managed to upgrade of late?
Yes, pharma is something that we are incrementally more positive on. First, as I said, there are certain stocks and segments where we have booked profits. banks, in terms of the results, as we discussed, have not been that great, and the struggle for deposits seems to be lasting longer than expected, frankly speaking. So some of that weight, we would not mind shifting to, say, sectors like pharma, where the scope for stock picking is quite good. So we are looking, and we have probably increased weightage there.
Right, okay, Mihir, good to have you on the show, and we'll see you again soon. It's a good start for the equity markets, banks holding up about almost 1% on the index, and Nifty counting down to 25K.
If you like this video, then like, share and subscribe to ET Now.